Hi, I'm James Robinson, and this is my stock pick of the week. This is my third video on the company NuSkin, symbol NUS. Today we're going to talk about the company's balance sheet. And I'm always surprised at how little time people invest in company's balance sheet and looking at the balance sheet. The balance sheet has a number of values that as an investor we should take advantage of. The first thing is, if a company has a very weak balance sheet, it means that they can't survive bad times. And since you know sooner or later bad times are going to come to every company, you want to take a look at that. Also, a balance sheet gives you a sense for the kinds of things that a management thinks are important, for the way they're funding the business. If a company, for example, is having to grow their business by taking on a bunch of debt, that's a bad sign. If a company is able to grow its business and they not only don't take on debt, but they're saving a bunch of cash, that tells you that company has real power in terms of earnings power. And so I think that there's a whole bunch of nuance that can be picked up by looking at a balance sheet. And most investors, they just don't even look at it. They might look at the total debt and that's about it. So as we go through this balance sheet, I'll talk about some of those things more in depth. The first thing that I always look at on a balance sheet is cash and marketable securities. That is how much money the company has in its pockets, and that's the money that the company can use to grow the business without taking on debt, to buy, to do acquisitions, to make investments. It's also money that the company can use to pay dividends, to use to pay great employees. It's also money the company can waste. And so a lot can be said by looking at the cash and cash equivalents, especially as those numbers relate to current liabilities, as those numbers relate to the size of the business. When you have a company that's hoarding a bunch of cash and they don't seem to have anything to do with it, as an investor, that's a waste because that company's not earning very much return on that money, and I'd like to see that money returned. On the other hand, when you see a company that doesn't have a lot of cash, then that tells you that maybe this company is playing it too close in terms of their margins of error, and you might want to run away from that company. So having said that, when we look at this company, we see that the cash and cash equivalents have been pretty stable since at about 300 million for the last 8 or 10 years. And that's despite the fact that the earnings have gone up pretty significantly over that period of time. That tells me that they're dispersing those profits out to us, the shareholders. It tells me they're not hoarding cash. And so I like a stable cash flow, a stable amount of cash and cash equivalents, especially when I know the income is going up. That tells me they don't need a lot of cash to run the business, and that makes the company more desirable. So the next slide is current assets and current liabilities. And again, we'll go over what some of these things mean because not everybody understands, not everyone is used to American accounting standards and American accounting terms. So current assets is assets that the company has that they could liquidate in a year. If they have a bond that they can't get to for 5 years, then that would not be a current asset, that'd be a long-term asset. So current assets, money that they get their hands on in the next year. Current liabilities are monies the company will owe in the next year. And so you like to have a sense that the current assets outstrip the current liabilities because that gives you a buffer zone. Now, obviously, the best current asset is cash. We already talked about cash. But when you look at this company, you see that they've got a pretty constant safety zone between the current assets and the current liabilities, but it's not going too big, it's not getting too wide. That tells me this company is managing the money pretty efficiently. This slide, which I call debt analysis, looks at the total current liabilities and the total current long-term debt. Oftentimes there's a relation between the two. And if you understand the business and you think about it, you can get a sense for what that relationship is and why things are happening that way. For example, you see that between 2014 and today, the debt level has gone up basically every year, and simultaneously the current liabilities have remained flat and have even gone down. And what that tells me probably is that this company is making some long-term commitments, for example, long-term leases, or taking on debt in lieu of having short-term obligations. So, for example, they may be buying inventory in greater bulk, and therefore they have a liability to pay that inventory, but they get long-term financing, for example. There's all kinds of crazy things that could be going on, but the point is, in general, the debt has been going up a little bit. The current liabilities have been flat. I'm not sure that I like that or don't like that. Obviously, I don't like to see companies that have their debts increasing at any point. Another thing that's interesting about this company is that the debts have been increasing since 2014. But when I look at the financial sheets, it looks like they pay no interest. And obviously that doesn't make any sense. And it's bothered me enough that I've looked at this from many different points of view. I've looked at it in their annual report, and I've looked at it on 2 or 3, Yahoo Finance and a couple of the finance sites. And I'm not sure what's happening with the interest and why they're not paying it, but it doesn't appear that they're paying any interest expense. So more about that later. So here's a slide of the interest payments. This looks at, the second slide looks at, the second chart looks at interest income as well, but there isn't any. So what I basically have done here is I've just imputed an interest. I said, look, if they have $400 million in debt, which is, about the amount that they're at right now, and they're borrowing the money at 4%, that would be $16 million. So he just said, okay, let's assume the company's paying $16 million and they're doing it some way that, I don't know what they've done to defer it or why it's not showing up in this data source. But assuming that that's the case, $16 million is not an egregious amount of debt relative to the company's earnings, relative to their operating expense. It's really not a problem, but it really does bother me that I can't figure out why there's no interest expense. This chart again just looks at the interest coverage ratio. And again, I don't have the interest data that I should have. I'm not seeing the numbers that would feel like they make sense to me. So I've imputed it. Long story short, this company makes about $190 million a year. If they had $400 million in debt at 4%, they'd owe $16 million a year in interest. The company made $190 million, so that's a 15 times, an interest coverage ratio of 15 times. So interest coverage ratio is how many dollars of interest do you owe related to how many dollars of income you have. I like to see $3 of income at least for every dollar of interest. In this company, it's 15 times or 10 or 11 times, I guess. So there's no problem here with the interest payments. The debt is not a problem for this company. If it was, and I couldn't answer this question about the interest payment, I would just simply walk away from the company. But I'm confident that the interest isn't a problem, and I'm confident that debt isn't a problem. And so other than for purposes of just trying to understand what's going on, I'm really not that worried about it. Another metric that I use to measure debt as it relates to the company is to say how many years of income does it take to pay off 100% of the company's debt. And I like to see that number be at about 4. So 4 years of income to pay off the debt is, anything below that is great. Anything below 10 years is acceptable. And you can see this company's never really been above 2. I guess it was above 3 1 year, but basically it's about 2 to 3. So it's very, very safe. The debt is related to income is really not a problem. And this company's in good shape for a balance sheet. Here's the company's debt to equity ratio, which means how much debt do they have for every dollar of equity. It's just under $1 of debt for every dollar of equity. So it's great. It's in the top 25% of companies. Yet another way of saying that the debt for this company is not a problem, and that they have plenty of reserves to run their business, even through bad times. This is looking at current ratio. Current ratio is the relationship between your current assets and your current liabilities. And you like to have that number be as high as possible. You like to have as many dollars of current assets as you can for current liabilities. However, having said that, there is a point of diminishing or vanishing returns. I don't want to have a company hoard cash because they can't use that cash effectively very often. And so, while you can see here that, 4 times a current ratio of 4 is, pushing the top 10% of companies, I almost would consider that a red flag, because I'd be saying to myself, why do they have so many current assets? Why aren't they just liquidating those assets and paying some of those to me, the shareholder? And so as long as you're in a reasonably sensible range, and as long as you're in a very flat range, in other words, you constantly seem to have the same buffer between those two numbers, that tells me that you're probably doing a good job of managing the money. And I'm not really that concerned that you're in the top 10% of companies in this category. So that sort of does it for the company's balance sheet. They have an adequate amount of financial reserves in their cash and marketable securities. They have an adequate amount of, they have a relatively low amount of debt. It doesn't seem like they're hoarding cash. Seems like they're doing a pretty good job of returning cash to the shareholders. So in general, I think that this is a real strong suit of this company. It's one of the things that kept me interested, even though I saw that the company's operations were maybe only slightly above average versus being excellent. But long story short, again, I think NuSkin is a great company. I think you should consider buying it.